Right. We're going to start today by looking at our calendar. You can see that we're starting the month of October, which is seasonality wise, it's one of the best months of the year. You can see from our monthly stock market returns, this doesn't always work, but the last 3 months of the year are usually good because the theory is we have a lot of holidays in these months, and holidays make people feel a little better. And we have three big holidays, Halloween, we have Thanksgiving, Christmas, and New Year's, all together jam-packed. Um, so let me see. So September was actually a decent month. It wasn't that bad this year. So this seasonality doesn't work all the time. Okay, so let's look at our calendar. We have earnings season coming up in 2 weeks. We have the banks reporting first, like they always do, and then we have some of the tech stocks come up. Apple, Google, and then NVIDIA is last in the end of November. So we have all that to look forward to. And a lot of times when earnings come out, that really helps the stocks go up, and sometimes makes them go down. But um, there's definitely a preference for stocks going up towards the end of the year. And we also have the Santa Rally, which is the last couple weeks of the year. Um, Usually stocks go up then also. So what else do we have to look forward to? A lot of our government reports might not be coming out. So we've had job reports on a regular basis, but with the government shut down, that could change some things. Might not get some updates. Um, so let's look at the S&P next. You can see the S&P, we continue to trade above the 20-day exponential moving average, which is a positive sign. I've been saying that as long as we're above this 20-day exponential moving average, seems like the stocks will continue to go up. So we'll look at any breaks we have in whenever this chart goes below that level. And we're above all the other moving averages also, the 100-day, 200-day, 50-day. So that's all positive for momentum. But we're overbought. But we've been overbought for 6 months now. Um, so the overbought uh, the indicator doesn't really work that well when everything is going up. Let's look at the 10-year. 10-year has been going down. Look at that. Um, and let's look at it in comparison to the S&P. You can see as the 10-year yield is going down, the S&P has been going up. So there definitely seems to be an inverse correlation. The less it costs for companies to borrow, the more profitable they are. That's the theory with this. All right, let's go back to our talking points. Okay, so this past week we had wait, let me see. This past week we had earnings from Nike. They had better than expected earnings. We had Carnival and Paychex. You see, and there's not too many companies that come out with earnings next week, so I didn't put it up there. Okay, let's look at some more numbers here. You can see that we have 50%, 54% of the S&P above the 50-day moving average, 62% above the 200-day. And our translation here is if it's above 70%, that's a bullish market. So a large majority of stocks trending upwards means broad market strength. So it seems like we have a bullish kind of market right now. Um, okay, so we've had this on our idea list since the beginning of the year. Revert to the mean. Healthcare this week actually went up double digits. Um, very revert to the meanish this week. And all it took was like a couple mentions from the administration that they're going to be more lenient on the drug sector for tariffs and things like that. And so we're going to go over some healthcare names um, and see if there's anything, see if there's any babies that were thrown out with the bathwater, as they say. We can look at our stock screen from this week. We can see we've seen Merck in the bargain basement for at least 8 months now. And finally, it was a peg ratio less than one. Finally, it traded up double digits this week. So we're gonna have to pay more attention to some of the larger companies that are undervalued um, going forward. Okay, let's look at some more of what's going on here. You can see that, hold on. You can see the trend lines for the S&P 500 is like a perfect drawing right now. Um, and the chart is basically falling within this range. I think every stock market participant that's in a major position understands these trend lines. And when it gets down to the bottom of the trend line, the algorithms buy, and when it gets to the top, they sell. So, but we are overbought right now. So we've been overbought for a long time. Um, there's nothing really earth-shatteringly exciting about this chart right now. Let's see what else. Okay, so, okay, hold on. All right, so oil is up 4% this week. It's still really low in price. That's kind of an indication that the global economy is kind of slowing. Inflation is still about the same, 2.92%. And the dollar index is up a little bit from last week. Gold is up 2%. Gold is still on a tear. Gold is up over 40% this year, and it keeps going up. Um, and the dollar continues to go down. You can see the dollar is in a downtrend. Okay, so fear and greed index. Greed, we are neutral. That's a little bit, we were neutral last week. So right now there's actually no action to take. Whenever people are extremely greedy, we don't buy and we take some off the table. And when people are extremely fearful, it's time to hold your nose and buy some. But right now we're in the middle and we're in no man's land right now. And we don't have a whole lot of catalysts coming up in the next 2 weeks because there's no government reports and there's no earnings for the next couple of weeks. But after 2 weeks, we'll have some earnings. Right now, the AAII investor is bullish. So usually whenever the amateurs are buying, that's the time the professionals are selling to them. So you have to be very cautious whenever amateurs are buying. Okay, so the VIX, we are at multi-year lows, and that means people aren't really afraid right now, and there's no fear in the market. So that's a good prediction that stocks are going to continue to go higher. Um, Emotional graph, we're still at the top, a new paradigm. We have bullish momentum for amateur investors, and and we have a lot of momentum, over 70% of stocks above the moving averages. So, okay, so we see, okay, PE ratio is 25 right now still. Okay, so that is maybe some may call it an overvalued market. I got an article later on we're going to go over where what do you do whenever you haven't you everyone knows it's an overvalued market and we have a bubble. What are the best things to do in this kind of environment? And we'll go over that. My my tendency is to understand what you own right now may be overvalued. And, whenever the market cycles and it comes down and the market goes down a little bit, then it'll be fairly valued. So I have a tendency, I have a tendency to do nothing whenever the market is overvalued. And we'll talk about that later on. All right, so um, let's look at some of the sectors doing the worst and the best this year. You can see the communications sector is doing the best. That is stocks like Google, Meta, um, and the S&P 500 tech sector. So technology is up 20%. The industrials up 15%, utilities up 14%, S&P up 12%. So one interesting thing, um, since last since last week, the financials, no, that's not the financials, the healthcare um, went up like 10% from last week. So we finally have a reversion to the mean. We have healthcare outperforming this week. And we'll go over some healthcare names later on. But you can see from, let's see, this chart here, you can see healthcare is one of the most undervalued sectors. And then energy is below that. So, and financials are also a little bit undervalued. What I did this week, I thought it'd be interesting to go over a financial name, and we can talk about healthcare a little bit more too. And part of um, part of being a good investor is to accumulate and dollar cost into quality names when they are out of favor and no one else wants them. So right now, the healthcare sector is still um, an unloved sector, and so so there might be some good buy and hold companies there. Energy, it's really hard for me to invest in energy stocks. I own ExxonMobil. Um, Whenever they were crashing, whenever stocks were the energy sector was crashing in the COVID lockdown, I bought some ExxonMobil, but it's really hard um, to invest in this industry because they're all at the mercy of the price of oil. So if the oil price of oil goes down, the profitability of all of the energy companies go down with it. So okay, let's go cancel that. I don't know what happened there. Okay, let's look at some. Okay, what's going up and down today? Okay, so we're going to look at market movers. Okay, okay, so we have a lot of health care related companies going up. We can see Centene. This was one of the stocks that we reviewed last week whenever we were looking at the undervalued value names. This was in the Oakmark Fund, one of their top holdings. It's totally out of favor. Um, but now that it has a little bit of momentum in the sector, people are starting to buy a lot of it. Um, so this is a lot of these stocks that are healthcare related. So Humana, Centene, Molina Healthcare. Okay, so this is an example of reversion to the mean. This week, as a lot of these healthcare names rebounded, and it could be a good time to start looking at buying some of the healthcare names because they've been so out of favor for such a long time. 3 years they've outperformed the market. This um, Going back 50 years, the healthcare sector compared to the S&P 500 has never been as unloved. So the dispersion, let's look at this. Okay, so going back 50 years, the healthcare sectors If you compare its valuation compared to the S&P, it's the worst that it's been in 50 years, which is pretty amazing. So that's why I'm starting to buy some of the healthcare stocks, and I'm just nibbling. My position sizes start at like 0.5%. Okay, so let's look at, okay, we're looking at the ups and downs. We can see, okay, some of the ones going down the most are Palantir. Wow, this is one of the most overvalued companies in the stock market, maybe of all time. Um, it's at 173 right now. You know, it's only grown at 30%, but its PE is above 100. It's like 100 and something. So it is very overvalued. That doesn't mean it can't continue to grow. Las Vegas Sands, Wynn Resorts. I'm not sure why those are down so much. I don't have any themes here though. We have some chip names going down a lot. We have AMD, we have CLA 10 core, we have Applied Materials. These are all chip related names. Okay, I can't, that's all I can get from them. Okay, look at this. This is Micron is up. It's up double digits since the last time we talked about it last week. It's an example of a stock we thought was undervalued by, well, CFRA says they're undervalued 100%, meaning they could double and then be fairly valued. So let me see the ones. Look at other ones going. Look, the rest of these ones in the top 10 are mostly um, Biogen. That's a healthcare. That's a they're a drug stock. AstraZeneca, they're a drug stock. So all the drug stocks are making a comeback. So this could be the first week of a comeback for that sector. We'll see. Okay, so I'm going to look at some of the stocks. Look at this healthcare fund, healthcare ETF, XLV. You can see that it's been in a downtrend for at least multiple years. This week, it broke out and went up double digits. So could this be a breakout or a fake out? I don't know. It could be, we have this range right here. Could it be breaking out or maybe it goes back down to here? We don't know. But it was all based on a news story. So we're going to keep watching that. All right. So where were we in our talk here? Okay. Let's look at, oh, let's look at the sectors going up and down too. Sector ETFs. Change. Now, let's look at the 10-year. The 10-year has been going down. So when the yields are going down, that's positive for small cap, heavily indebted stocks. Cost to refinance are lower because of that. High yielding stocks, it's good for them because um, there's more of a demand for yield whenever a guaranteed yield of the 10-year treasury goes down. Home builders will be positive, speculative, and REITs will be good. Negative for large cap stocks, financial sector, and insurers. Let's see if that happened this week. Okay, so technology underperformed. Okay. Semiconductors. Okay. The ones did the best. Utilities, high yielding. So as the yield for a 10-year goes down, high yielding investments go up. So healthcare, they're up because well, they also have a good yield and the sector is on fire. Oil is up, regional banking, biotech, they need to borrow money. Whenever interest rates go down, that helps them. Telecom, they're a big dividend player. So dividends are in demand when the yield of the 10-year goes down. Also, home construction, this is all in line with lower interest rates. So this matched perfectly to our prediction here for when the yields of the 10-year go down. So the large caps went down, and the high yielding stocks went up. Home builders went up. Okay, so that's a perfect match. Doesn't happen all the time. All right, let's look at the Dan Niles picks from the beginning of the year. We see the banking sector is on fire. All the big banks are up 20%. ADTN up 13%. Cisco is up 15%. And the mid caps continue to flounder around. They're only up 5% this year. Here's the note from Dan Niles. He says he believes this shutdown could last even longer than in 2018. But you can ignore that. You can ignore the shutdown stuff because the Q3 earnings are going to be solid. So when companies report this month and next month, they're going to be good. AI euphoria continuing when the Mag 7 reporting. Okay, he thinks the Mag 7 are going to be reporting good quarters. And the Fed meeting, they think they're going to be continuing to cut rates. All that helps the whole stock market go up. So he is really thinking the stock market will continue to see new highs at the end of the year, very slowly. Okay, let's look at some of our charts that are important. We broke out of our multi-year downtrend with the healthcare sector. So it's a very good time to start looking at some of the healthcare names if you're interested in them. Let's look at Google. This is Alphabet. You can see that it's trading above its 20-day exponential moving average. It's kind of in this comfortable level here, this up trend, and we're a little bit oversold. You can see it trace back a little bit. It's still outside of its trading lines. Let's look at the AT&T. AT&T has been in this sideways pattern for a while now, but you can see it broke down just a little bit and it's oversold. Usually AT&T kind of trades with a high yielding stock, so it should have been up. It was up today. But I'm not sure exactly why it's trading down a little bit, but it's hitting its 200-day moving average right here, this purple line. So there could be some support right there for AT&T, especially when the yields of the 10-year are going down. People are going to be reaching for yields. Let's look at Meta. Meta is totally out of favor right now. You can see it's oversold and at the bottom of its trend line. So I always like to point out stocks whenever they're oversold. Look at Netflix. There was a story on that Elon Musk he doesn't like one of the shows on Netflix, and he said, cancel Netflix. And Twitter, X has millions of people that hear that message. So um, that might affect Netflix. That's why it went down this week. But you can see that it's still in an uptrend. It's at the bottom end of its range, and it's kind of at a decision point right now. It's oversold. You can see oversold. Now Netflix is very expensive. It's trading above a peg ratio of 1. So whenever a stock trades above a peg ratio of 1, let's look at it just for fun. Let's look at let's look at I like to look at these key statistics on Yahoo for just an overview of how expensive a stock is. Okay, so it has a PE of 37 now, and it's probably grown around 20%. So that means it's 30% overvalued. So if we'll divide the price that it's at right now, so 1153 divided by 1.3. Okay, 886, it'll have a peg ratio of 1. So that's whenever there's bad news in a company, a lot of times if it's really bad, it'll trade down at least to its peg ratio of 1 if it's a big company. Um, I'm not sure. It's I'm not sure if this is going to affect the subscriber numbers. I think if the people they might lose from this news story, they'll gain um, maybe from other countries or something. I'm not sure. People are not following X. But I don't think that'll affect the stock that much. A good portion of whenever you're an investor is trying to understand if a news story will affect the long-term thesis of a stock. And that one news story, I don't think is going to affect the long-term thesis of Netflix. They still have the best content. They still have a best value proposition. $20 for unlimited month of movies is a good deal for an average family. So I think they still are going to retain a lot of their customers, most of them. So I think it's a non-event story. Okay, so let's go back to our talking points. Eli Lilly, um, we've been following this stock for like forever, and um, they came out with this bad news. You know, they were down 18%. And when it was at this bottom point here, we kind of concluded that news story was BS. We shouldn't pay attention to it because it was a faulty study. And um, it seems like right now, healthcare got a kick in the pants, and all the healthcare stocks are up. So basically, it went up double digits this week, like 18%. So, but it's overbought right now, and it's kind of at the top of this range. So it seems like it fell into this range now. So it looks like it's going to be zigzagging like this until the earnings come out. Um, but I think this is an example of whenever stock sectors are out of favor and stocks are out of favor, um, it's a good idea to start dollar costing into stocks, especially when they're big companies and they're quality companies. Okay, so let's look at T-Mobile. You can see that T-Mobile is kind of trading with some of the high yielding stocks because it's in a telecom sector. You can see it's um, oversold right now and it's at the bottom of its trend lines. So it's still growing. It's still taking market share from all of its competitors and it has the best service in America. So they have the best coverage. So I like to point out the stocks when they're at the bottom of their channel and oversold. All right, so let's look at okay, another reminder from this Twitter guy. Um, they say stocks rise when the Fed cuts rates outside of recessions. So right now we're not in a recession and the Fed is cutting rates. And they say a good percent of the time, a year later, the stocks are going to be up because um, cutting rates helps stocks outperform better. All right, I had a stock screen. I had a couple stocks that were interesting. Um, one is um, one is Barclays. They're a bank based out of the UK. And another one is Yelp. And we already looked at DoorDash before. So reason I'm looking at these is each one of these has a peg ratio of less than 1. This week I sorted the stocks based on the peg ratio. So this is the peg ratio right here. And a lot of these stocks are, undervalued for a reason. Like you have some stocks that have some debt issues, and they're in sectors such as solar that are being annihilated by the president right now. So it's really hard to fight administration changes, um, like taking away tax credits for EVs and solar powered things. So I thought it'd be interesting to review stocks that seem like they could rebound. And this one, Barclays is like a 300-year-old company. So I thought if they lasted this long, it'd be good just to check them out if they're half price. So PEG ratio 0.52 means they're half off. And Yelp, it seems like they're 25% off. Um, and then we know DoorDash, they have 65% of the market in delivery. So that's pretty good. They're number one in their industry. So it's always good to look at the number ones um, when they're on sale. All right, so let's look at Yelp. Yelp is they're a company that you go and you get advice and reports and information about companies that other people have written about them. So it seems like I looked at their fundamentals here. They're uh, they're growing around 20% now, 27% this year to next year, 21% the year after. And then look at this, negative 6.8 growth from the year after that. So this is decelerating growth. I like to buy stocks that are going up 10% or more per year in a consistent manner. Why is this, why are these estimates going down like that? This year is the most concerning to me. Why in 3 years would there be negative growth? Um, okay, so Yahoo Finance doesn't have a forward PE for some reason. I don't know. I think it's 8. Um, and they say their PEG ratio is 0.4. So that's a good hint for us to start looking into it and see if there's any value here. It's a small company at a market cap of 2 billion. So it's not my normal cup of tea. I like to buy stocks that are mega caps because they have a little more financial power. Um, okay, so the numbers are they're growing around 21% now. Their PE is, let's say, 14. That means their PEG ratio is um, around 0.5, which is half off. Um, Problems are they have decelerating growth, like I mentioned, 27, 21, -6. They have competition with AI. Not as many people are clicking past the AI overview on Google. So they're probably getting less traffic, and that's less advertising revenue. They're and they're almost 100%. They're a good percent dependent on Google for their web traffic. And AI is hurting, AI overviews in Google are hurting their traffic. So their business model is being disrupted by AI. So this is a story that, it looks like it's on sale, but it's on sale for a reason. Their business model is being disrupted. Um, Seems like this company needs to add AI to their services in some way to, to fight these changes. Otherwise, they're going to have negative 6% growth in 2 years. So I guess if I was following this company, I would put a bookmark on it and see if they're in any way making changes to adapt to this new AI environment. Um, I asked Google, why is Yelp stock down so much? And they said, Google said, as of October, Yelp has fallen due to cautious outlook from management, declining traffic in its core restaurant category, and stiff competition from tech companies. While the company has seen strong growth in its services division and profitability, these positive trends are being overshadowed by broader business challenges. So they gave cautious forecasts, and they have intensifying market competition. So Google is dominating, and they're actually taking business away from them. So there's the threat from AI I just talked about, and their competitors now are Facebook, Instagram, and Google. So this is like a David and Goliath, and they're the David, and they're losing. And so when you have maps. Yeah, they're competing with um, companies that could squash them if they wanted. I mean, Facebook could come out with a Facebook Yelp, you know, and that's what they did with Marketplace. They copied Craigslist Marketplace, and that changed things a lot. So I don't see a way forward with this company. So I'm out. If I was looking at this company, their profitability is great now, but I'm sure this is going to be declining over time. They have over 250 million in cash. So they're not even in debt. They're making money. They have positive cash flow. But the interesting thing here is they have a 13% float that is short. 13% of their float is short. That means that if there's any good news on this story, the stock will like pop due to short covering. So if you see right now, you can see this. This has one of the best chart patterns. Um, okay, look at this 20-day exponential moving average, and you can see that it's almost turning positive, and you see the chart is like right around that 20-day exponential moving average, and it's basing right here. See, that's a basing. So the longer the base, as Louise Umana said, the higher in space. So if this was a stock that had a future, I would be interested in it just on this chart pattern. But um, they're going to get wiped out by AI, I think. So I think it doesn't have a chance to compete against Google and Facebook and Amazon. Um, so for this kind of stock, I like to buy stocks that I can buy and hold for 10 years. And this is a stock I can buy and hold for like 6 months. And unless they have some kind of new initiative, like AI initiative, I think I wouldn't be interested in this, even though it's undervalued. Okay, let's look what CFRA says. They actually have it as a strong buy. They mentioned that Yelp's PE ratio is 8 compared to the average PE in the industry of the advertising industry is around 30. So they're totally undervalued, but they're undervalued for a reason. They're actually probably losing their customers to Google. Here's another stock that fell in our screen. Barclays. It's trading at a PE ratio of 7. A lot of the European companies, this is European company, a lot of European companies have a very low PE compared to America. But this one had a PE of 7. I like companies that have been around a long time. This company has, in 1690, they were founded. So if this company lasted this long, they must be doing something right. They're currently out of favor. They're not out of favor, but they're not trading at a normal multiple. The 7 PE is very low. So let's look at why it might be undervalued and see if there's any value here. It says these are the earnings estimates. According to the earnings estimates, they're growing 27% from this year to next year, and then 23% after that, and 14% after that. So if they're growing at 25% and their PE is 7, then they're about 72% undervalued. And I asked, if you look at their chart, they have an excellent chart. Look at this. It's a straight line up and it's a perfect, but it's just not being, it's out of favor right now. It's not being, I guess it's not fully valued. It's undervalued right now, but you can see it's oversold and at the bottom end of its trend lines. So I asked Google, why is Barclay stock down so much? And it said it's due to sentiment and broader macroeconomic factors rather than a single event. That's good for us looking for a stock to buy because if a drug is down because the drug sector is down a lot, that's a good indication we might have some babies that were thrown out with the bathwater. But they said with recent concerns, including potential U.S. interest rate cuts, UK economic performance. Okay, UK is an in, and interested bank taxes, increased bank taxes. While the company is undertaking a turnaround plan, has shown growth in its investment and wealth management business, investors are wary of sustained earnings momentum and lingering economic volatility, which is influencing share price. So I guess a portion of the reason the stock is down is due to the UK economy. I don't know anything about the UK economy and the rules that they have for banks, but I'm just looking at the earnings estimates. Um, so I might miss something about, the macroeconomic reason it's down. But some of the reasons for it to go up, according to Google AI, is the shift towards increasing fee-based revenue from interest rate-based income. And the other thing is strong investment banking performance. And according to Google AI, they're undervalued despite recent volatilities. Barclays shares are seen by some analysts to be undervalued compared to its peers with a low PE ratio. Um, so they're basically half the valuation of American banks or more. Um, okay, so let's look at what CFRA says. They say our recommended 3 stars hold. We are positive about the strategic pivot from stable income streams and UK-focused growth. 28% year-over-year growth in Q2, beating consensus by 11%. So they have good earnings recently. Demonstrates operational momentum. Their diversified business model provides resilience against monetary policy shifts. Their buyback reinforces confidence in the shareholder return commitment. Credit impairments will likely exceed 2024 levels again because the economic pressure is tougher than U.S. consumer conditions. They bought a bank, and that acquisition will help the company. Okay, so they also said that there could be some problems with the UK economy. People are defaulting on their loans and financial products more than America. So that could be like a temporary thing. Let's look at what the fair value. They didn't put a fair. I hate it when they do this. So we don't have that warm feeling in our stomach for a fair value um, from CFRA. A lot of times that happens whenever you have foreign companies or companies that are smaller. They just don't want to commit to a value because it's kind of dicey right now. Um, let's look at what Morningstar said. They had a fair value of 16.3, so they think it's around 20% overvalued. Okay. But they didn't have anything else to say. They were basically low coverage for a foreign company. Okay, so all right, so let's look at another article here. So the historical bull and bear markets. We mentioned this, we saw this chart many times before. This is Ben Carlson. Um, he runs a pretty big asset managing company. He says there's a symmetry to bear markets in the short term. In the long term, there is an asymmetric relationship between bull and bear markets. You just have to survive the short run to get to the long run. So in other words, you get more return in the bull market than you lose in a bear market, usually. So whenever it's really bad times, you just have to look at the big picture, and you're going to make more in the bull market than you'll lose in the bear markets. Okay. This same guy, Ben Carlson, wrote an article, How do you invest during a bubble? This is very interesting because, I'm a long-term investor, and I like to um, look at different opinions of, what to do, whenever you have a long-term portfolio and you know that it's getting overvalued. Um, this guy said three things. You can go all in, meaning when I see a bubble forming, I rush to buy, adding fuel to the fire. You could hedge, meaning you're always nervous. So you could buy puts or invest some kind of hedging strategy, such as buying gold or real estate or something. You could diversify, even if you're 100% certain we're in a bubble, you don't have to go all in or nothing. So that means in this environment, you don't have to buy all tech stocks with AI. You could buy some, you can start dollar costing into some healthcare stocks, like I've been talking about. That could cushion the blow whenever AI starts going down. Or you could do nothing. Nothing is a choice too, as long as you have an investment plan that suits your risk profile and a time horizon that you can follow. Okay, so, but he mentioned something really interesting here. I'll read this because it's really interesting. Th- Okay, this Jeremy Grantham, he's really good at predicting financial bubbles because he predicted like 2000, 2008. Here's what he wrote about the current cycle. He says, the long bull market since 2009 has fully matured into a fully fledged epic bubble, featuring extreme valuation, explosive price increases, frenzied issuance, hysterically speculative investor behavior. I believe this event will be recorded as one of the greatest bubbles in financial history, right along with the South Sea bubble, 1929 and 2000. And there's more about that same quote. But what's interesting is he wrote this in 2021, and that was right after the crash and recovery. And despite the bear market and Liberation Day and a bunch of other things, the stock market has almost doubled since that time. So that's returns around 15% per year. So that's just an indication that even though stocks may seem overvalued, the sometimes the best thing to do is nothing, and that's what the that's what this article is all about. And this author, his name is Ben Carlson. He said the best thing he likes to do is nothing. And I'll explain a little bit about how I like to handle this kind of situation. Well, how do you implement a do nothing game in bubble times? My approach is buy and hold companies that are growing 10% or more on average. During market bubbles, you have to realize that quality compounding companies prices may be overvalued. Like right now, have Microsoft that is has a peg ratio of like 2 or 3, and it's only growing like 10%, and its PE is 30, so it's pretty high valued. But over time, if you hold that stock, it'll grow into its valuation. So sometimes the best thing to do is to hold. Look for stocks that have a peg ratio under 1, undervalued, and possibly sectors that are out of favor and dollar cost into them. For instance, a few weeks ago, I mentioned Eli Lilly was selling off 18%. And at that time, I said, we have a sector that's down, the healthcare sector, and we have Eli Lilly was at peg ratio of 0.7. That means it's 30% undervalued. And right then I said, um, that's an example of throwing the baby out with the bathwater. And so that's an example of what you can do during market bubbles. You can dollar cost into high quality names that are trading at a discount. And that's how you can participate instead of piling into Palantir or a very overvalued stock. All right, that's all I had to say for today. I hope you enjoyed that talk, and I'll see you next time.